I know you guys have seen people making hundreds, thousands, even millions of dollars overnight with none other than options trading. Well, if you watch this entire video, you will know exactly how to make the same gains you see other people and myself posting all over social media. Welcome to the ultimate guide to trading options. If you guys are new to my channel or new to the stock market in general, you may have absolutely no idea what options even are or why people are making so much money with them. So let me give you guys a quick explanation of what options are just to get us all on the same page. Options are simply contracts that allow you to own 100 shares of a stock for a certain amount of time. And the reason why these are such good investment strategies is that when you buy one of these contracts for 100 shares, you're paying significantly less than you would pay for 100 shares of the stock outright. Let's take AMD for example. If I were to buy one options contract, I would be spending around $2.54 per share or $254 in total on this options contract. Now, if I went to buy 100 shares of AMD outright, I would be spending upwards of $10,000. That's the power of options and why people are making so much money with them. For example, when I first started investing in options, I bought 5 contracts for a company called Virgin Galactic, and this allowed me to own 500 shares of the stock. I spent about $1,200 in total and turned that into $3 grand in 20 minutes. And people are doing crazier things than that, so if you want to learn how to do these things, stick around, grab some popcorn. It's gonna be a good video. All right, let's start with the introduction to options. So when you first start investing in options, there are only 2 different contracts you can buy, a call or a put. You would buy a call contract when you believe that the price of a stock is gonna go up over time. So let's say a perfume company called Stink is trading at $90 per share right now. If you believe that the price of the Stink stock can go up over time to maybe $105 or $110, then you're gonna buy a call contract. Whereas if you think that Stink is a really garbage name for a company and you think that the price of the stock is gonna fall over time, then you're gonna buy a put. So now that you know that, let's head over to Robinhood so we can see exactly how we can make some money with trading options. So once you're on your Robinhood account and you found a stock that you wanna start trading options with, go ahead and hit trade and trade options and you'll get to a screen that looks like this. Now, there's gonna be a bunch of dates at the top. February 4th, February 11th, February 18th, and so on. Those dates are called your expiration dates or how long you want to hold the stock until. So let's say I want to hold this contract until February 25th. Then you're going to click on your February 25th expiration date. Now you're going to get to a screen that looks a lot more confusing, but trust me, I'm going to explain all of it to you guys. So under those dates that we saw beforehand, you're going to see the option to buy or sell. Right now, we're only going to focus on buying contracts. I'll explain selling later on in the video. But next to that buy and sell option, you've got the option to either buy a call or a put. So we know Microsoft right now is sitting at $309 a share. So if we think that the Microsoft stock is going to go up by February 25th, then we're going to buy a call. Whereas if we think it's going to go down, we're going to go for a put. So when you look at this screen, you see 310 call, 315 call, 320 call. These are all of your strike prices. Basically, a strike price is the price that you think your share price is gonna get to. So if I think the share price of Microsoft over time is gonna get to 325, then I'm gonna buy one of these contracts for $3.25 a share or $325 in total. Now that $3.25 per share right there is called your premium. A very simple formula for finding how much money you're gonna spend in total for this contract is multiplying your premium times 100. Since you're spending $3.45 a share and you're getting 100 shares, you're gonna spend $345 in total for this contract. And you might be thinking, why don't I just buy this $380 call for $1? It seems like a complete steal, right? These contracts that are so far above the share price are called out of the money contracts. Whereas contracts that are below the share price are called in the money contracts. So the only way for you to make money on this $390 call for Microsoft is if Microsoft rises like 80 bucks in 1 week, which is pretty much impossible. But that's how you see people make stupid amounts of money in options sometimes, because people will buy $1 contracts super far out of the money, and then the company has a ridiculously good day gaining 3,000% the next day, and they turn their $1 into $350,000 overnight. The reason why you only make money if your call goes in the money is because of something called intrinsic value. So the way to find intrinsic value, it's going to be the difference between the current share price and the strike price that you're looking at. So if we take a look again at our $390 call for Microsoft, and we take the difference between the two, we'll end up getting a negative number, which means that there is no intrinsic value in this contract. But if the price of Microsoft shoots up 100,000% in one day and your contract ends up going in the money and you take that difference again, then you might end up actually having a positive intrinsic value, which means you will make money on that contract. So let's talk about puts. As I said earlier, you're only going to buy puts if you believe that the price of a stock is going to drop over a certain period of time. So let's say that I think Microsoft is going to have an awful week next week, and I think that the price might drop down to $280, then we would be looking into buying a $280 put. Now these work exactly the same as calls. The more intrinsic value you have on the contract, the more money you're gonna make from them. Puts are a huge strategy to making a bunch of money though. For example, if a company has bad earnings and you know that they're gonna have a bad day in the stock market the next day, you can buy a put and the next day the stock price will tank. You'll make money from it instead of losing money if you just own the stock. Some guy actually just did this with Netflix. So Netflix ended up reporting earnings that were way less than expected, and this guy took advantage of that. He bought $6,000 worth of puts and ended up turning that into $170,000 overnight. That is absolutely bonkers. All right, so we're done learning about buying calls, buying puts, and exactly how it works, or so you thought. If you click on one of these options, you'll see a screen that looks a little something like this. Now there's a few key things that we need to look at on this page. The first is your IV, or implied volatility. So this is where market makers take the advantage of how volatile the price actually is, and they build this into the price of the contract. So you'll notice that the higher the implied volatility is on this contract, the higher the price of it. So a general rule of thumb is if you see an implied volatility over 100%, do not buy the contract. The reason why is because anything over 100% won't make you any money. The key is to buy when IV is low and sell that contract back when IV is high. That way you're making money in the process. Now this one's pretty self-explanatory. It's just your chance of profit, but it's a pretty good thing to look at before you buy a contract. If it says 0, do not buy that contract. You're probably not gonna make any money on it. Let's get to the real important things. These are called the Greeks. The only ones we're going to talk about right now are delta, gamma, and theta, because Vega and Rho, we're going to need an extra video just to talk about those two alone. Delta is the amount of money that you're going to make per $1 increase in the stock. So if you have a 0.91 delta, that means that if the price increases of a stock by $1, you're going to make $91 on that contract. So my typical advice for people that are buying their first contracts is to make sure to buy contracts with higher deltas, because then they're getting more money per dollar increase. But remember, even if you buy with a low delta, the further in the money your contract goes, the more your delta increases. So you definitely can still make money regardless if you have a low delta or a high delta. The next one we're going to talk about is theta. Theta is something known as time decay. And basically what that means is, if you look at this number here, it's 0.0958. That means that you're going to lose around 9 cents a day on this contract. This is the reason why options can get really risky. If your theta is very high, then you have a very good chance of being beaten by time. Let's say that you have a $90 call for our stink company from earlier. On this contract, we've got a 0.44 delta. That means that per dollar increase, we're gonna get $44 back. Now let's say that you have a negative 1.12 theta on that contract. That means that every single day you have this contract, you're gonna lose $1.12 on it. So if the share price is going down instead of up on your call contract, then you're gonna end up losing delta, but as time goes on, you're gonna be gaining theta. So by the end of your expiration date, your contract is worthless unless it actually goes in the money. Now, gamma is not as important as the other two, but we're gonna explain it anyways. Gamma is basically the rate of change in delta every single day. So the gamma here is 0.0051, which means that delta is going to change by 0.0051 every single day. Now, as this contract gets closer to being in the money, then gamma increases. And as gamma increases, delta increases. So those are the technicalities of investing in options. Now, let's talk about different option strategies that can make you some money in the long run. The first one we're going to talk about is the out of the money YOLO, which is actually one that we already talked about earlier. But basically, this consists of buying a super out of the money contract that has little to no delta on it and getting that contract to be in the money by your expiration date. This will increase your delta but make you a ton of money. But as we stated earlier, if your contract is super far out of the money and you have a super high theta, that means that your time decay is going to be much more, and if your price doesn't get anywhere near the share price, you're not going to make any money on that contract. It's a risky play, but if it plays off, man, you're going to be filthy rich. The next option strategy is actually my favorite and one that I'm actually doing right now. These are called LEAPs, or long-term equity anticipation securities, if you guys want to use that. So what these are super long-term contracts with super high delta, and super low theta that are very, very far in the money. You basically have a 0% fail rate on these contracts, and you literally will always make money. Now, how does that make any sense? Let me tell you. So right now I own a $265 call from Microsoft. This cost me around $5,000 at the time, and right now it's worth $6,200. But basically, if you look at the contract, it's got a 0.73 delta and a 0.04 theta, which means that it's only losing 4 cents a day, and it's gaining $73 every time the price of Microsoft goes up. This is an incredible strategy because even if your money goes down, you have so much longer to recover because your theta is literally nothing. Meanwhile, if your strike price goes even further in the money, then you're gaining delta at the same time as literally having no theta. So it's literally an infinite money glitch at that point. That's my favorite one. If you guys want a longer video on that, please be sure to leave a comment on it because I can talk about that all day. The next option strategy we're gonna talk about is called covered calls. So covered calls are a little bit of a tricky one. They require you to already have 100 shares of a stock. This is why I don't really like this option very much because it does cost you a lot of money in the front end. But if you have enough money for 100 shares of a stock, you can make some easy money with covered calls. So how covered calls works is you sell a contract to a buyer and you actually end up receiving that premium that they pay. What you're gonna do is you're gonna sell a contract to a buyer, and if the share price stays below that price that you're selling at, then you receive all that premium and literally can just repeat that process over and over again and make unlimited amounts of money. However, if your share price actually does pass your strike price, you have to actually sell your 100 shares at the strike price you were selling at. So what you're gonna wanna do is pick a strike price that's super far out of the money because there's no way your share price is ever going to reach it. So you will never have to sell your shares and you can just keep selling covered calls over and over again until the day you die. Thank you guys so much for watching this video. If you enjoyed it, please leave a like and subscribe because I need all the support I can possibly get on this channel. I'll see you guys in the next one. Later.